Hi, everyone, and welcome to another episode of AI Interconnect podcast. I'm your host, Lauren. This show highlights leaders who are building real solutions at the intersection of technology, real estate, and AI without fluff, just practical insights. Today, I'm joined by Alan Snyder, founder and CEO of aShareX, and Alan's platform is opening up private market, fractional ownership, and even alternative assets like classic cars and fine arts and a wider audience. Alan, welcome to the show. Great to have you here.
It's an honor to be here with you, sir.
Wonderful. I really appreciate and let's have a friendly conversation. Let's start with you. What's your personal journey? How did you go from finance to building a platform like aShareX?
Well, it's been a long and bumpy journey. I grew up on Wall Street, Laurent, and I have this habit of starting companies. And when I was on Wall Street, I was survived endless mergers of different securities firms and ultimately ended up managing, or maybe they were managing me, pretty much most of the product areas and all of marketing for what became Morgan Stanley. And my swan song there was starting the Discover card with a few other people. After getting that started, I'd had enough fun and toddled off and started my own thing. And then called Shinnecock Partners, and we created a bunch of different financial products, funds, if you will, kept them going in the background, and then had this crazy idea, Lauren, of saying if you gave people the ability to compare insurance products head to head, you might have a business. Well, I should have known better because I'd run a large insurance company, and insurance companies are backward generally on the tech side. And so it was very difficult to build that company. Ultimately, battered and bruised, we became the largest seller of auto and home as a non-carrier in the United States. And years later, Allstate knocked on the door and said, well, we want to own it. And I said, God bless you, can take it over, which they did. And they still operate the company. It's called Answer Financial. And then went back doing the financial product stuff, and then said, most of the way that we invest in alternative assets are terrible for the investor. They give the investor no control. And I said, gotta be a better way. The journey for aShareX began. And so that's a little bit brief on my background. We can talk about aShareX or whatever else you'd like.
I really love it. Thank you for this. You make it short for a long journey. That's cool. Okay, was there a particular moment where you realized private market access had to change?
Well, I'm through Shinnecock, I'm an investor. And having formed, endless financial products, think about it. You have a money manager that says, Laurent, I've got this $50 million apartment building. And you say as an investor, great. How do I know it's worth $50 million? And the money manager says, well, you can diligence it, et cetera, et cetera. And I said, wait a minute. What is the current market value for that apartment building? And I said, the only way to know that is to have an auction for that apartment building. So then we said, all right, we're going to solve that problem. We'll build a full-on trading system to allow fractional bidders that want a piece of the 50 million, because hell, there aren't a lot of people that can plop down $50 million for an apartment building. And yet we know that the uber wealthy have all these advisors and say, well, you should buy that apartment building. But that leaves most of the people out in the cold. And so I said, all right, we'll create an auction system to allow fractional bidders to bid whatever they feel comfortable. Maybe it's $2,500, maybe it's $100,000 to get a piece of that apartment building. That meant we had to create a full-on trading system, a trading system that would allow fractional bidders to compete with each other, fair enough, and 100% bidders, all in the same trading system. Of course, that took us 3.5 years to build it. And so we did. We set down that path and we built the damn system. Now, then you'd say, all right, now you have true price discovery, current market pricing for the asset. In this case, an apartment building, it could be a $30 million Picasso, whatever. Now, you'd say, all right, what do I get to evidence my ownership in that building if I'm a fractional bidder? One of many, maybe. Let's say the fractional bidders win. We said we should give them, unlike a Regulation D security, which is exempt from the SEC, we said we should give them a Reg A security that has been reviewed by the Securities and Exchange Commission. Wow, now you have true, intense regulatory oversight. Every lawyer I know, this is a funny part of the story. Every lawyer I know said, Alan, you'll never get through the SEC. Of course, that was like waving a red flag in front of a cranky bull. We spent a year going back and forth with the SEC and convincing them that this was really powerful for investors. And lo and behold, they said, okay. So now the fractional bidder gets a true security, a common stock. Great, with regulatory oversight. All right. Then typically you'll smile. Most money managers say, Laurent, trust me, I'll know when to sell this asset better than you do. And of course, I know Homo economicus, they charge, I don't know, depending on the manager, 1.5% to 2% management fee every year that they're deciding when to sell the asset. Now, I don't mean to be too cynical, but shockingly, they love those fees. And they have a tendency to hold those assets a long time. Now, as an investor, I said, wait a minute. Don't I get a vote on when to sell the underlying asset? And of course, in a Reg D traditional deal, the answer is no, you don't. The money manager decides. All right. I said, give the shareholders by a simple majority vote the ability to say, I want to sell the asset. So now think about it. We've given price discovery, regulatory oversight, and control to the investors of when to sell the asset. Shazam. We've bottled a little magic, some sunshine. Now, the auction system we created is unique. There is no other system currently available that can do that. We've cleared the SEC. That's unique. We've given control to the underlying investor. That's unique. So this tech stack that we've created is powerful. Now, being the young sprout that I am, now don't smile. Okay. I said it had to have, which so many other players have not and have had problems as a result. I said we had to have full regulatory compliance. Wow. That meant that we had to have KYC, know your customer, anti-money laundering controls. Given the Discover Card experience, we integrated credit provider. So we actually credit score each bidder to determine what's a comfortable amount for them to bid because we do want to get paid. That's built. We had to integrate to 2 broker-dealers, one to issue the primary shares, and a second, if the asset is big enough, there'll be a secondary trading market. Yippee! That means not only do you control the sale of the asset, but just maybe there'll be a secondary market. In that $50 million apartment building example, you would expect there to be one. You'll have the liquidity of a secondary market. So you have 2 choices for exit: sell your shares or sell the underlying asset. Nice bit of power for the investor. Then we had to have a cash custodian with a bank. Oh darn, we can't run off with the money. Then we had to have a FINRA and a regulatorily approved transfer agent. All right, we did that. All of that's in place. And here's the thing, son of a gun, it all works. We've conducted, it's early for this company. It is very unique, but we have conducted several auctions, and we started out with fine art. Now, we processed 457 bids in 4 minutes in the last auction we did. I believe that's more bidding in 4 minutes than any auction house has ever processed. And it worked seamlessly. Now, as you can tell, we're investor centric. One of the things we learned, and you might find this interesting, I hope you do, or your audience does. When we did the research, we discovered that people that have gone into a charity auction, that have gone into maybe an auction at Christie's, Sotheby's, Hampel in Germany, any of the auction houses, they're not as comfortable as they would like. So we looked around and said, when you and I buy a new car, what do we typically do? We test drive it. We said, is there some functionality out there that would allow me to practice my bidding strategy in an auction? The answer was no. So we created Test Drive an Auction. It's on our website. Here's what you do. Test your bidding skills. You sign up and say, well, do I want to bid on a Ferrari? Maybe I want to bid on a Basquiat. Maybe I want to bid on a coin. Choose your poison. Then, poof, we ask you 2 questions. Do you want to bid as a fractional bidder or a 100% bidder? And how much do you want your bidding limit to be? You set that. And then, voila, you go into an auction. And the power of computers, we've generated hundreds of competitors to bid against you. So you can practice different bidding strategies, and it's randomized. So every time you have some fun with this, we've in effect gamified an auction, you get a different answer. So you can try different strategies. And people have found that very useful, not just with us, but with any auction system. Fine. Then we discovered on October, we're going to auction off a concourse quality Ferrari with 1,350 miles on it. Perfect condition. And the people that wanted to sell the Ferrari said, Alan, we don't want an English auction where the prices go up as more bidding occurs. They said, we want to do it as a fixed price auction. So, fine, back to the drawing board. We created a fixed price auction, in this case, roughly $227,000. I think it's a pretty attractive investment. And so we modified the system to be able to do that type of auction. So here we have a Ferrari, and it'll be one of many cars that we auction off. Pretty exciting, with the minimum bid of $2,500. You decide how much of that Ferrari you want to own. Maybe it's $2,500. Maybe it's $200,000. So we're going to do that on October 23rd. For anybody that finds this interesting, oh my God, we wrote a McKinsey-type white paper, and we said, what's happened with this mega trend of fractionalization? It's lengthy because we cover all of the different verticals to which this might apply. Think music. I don't know if you like music, but you want to buy a catalog of, let's say, Beyonce songs. They've been selling catalogs like that for $100 million, $300 million. But again, as typical individual investors, we're screwed. We can't participate. It's institutional capital only. So we said, well, here's a royalty stream. You can use our system to make this wide open to fractional bidders. So we talk about all the players in the music business and some of the players that are there and comparing aShareX to others in it. We looked at collectibles. Hold on to your boots. Comic books are selling for $6 million. Millennials and Gen Xers like collectibles. There's going to be a big auction of some dinosaur bones. A baby triceratops is coming up. Again, 100% bidders only. So you can apply our system to that. Here's another fun application, a use case for us. Sports figures, and this is starting to happen. The structure's a little cumbersome versus what we're offering. Let's say you have a sports figure, very successful, generating, $1.5 million a year, but would like to buy a house. So that sports figure can create an income share investment and say, all right, let me sell you, Laurent, 20% of my income for the next 3 years. Our system is almost an ideal execution to do that because that sports figure has a real fan club. So that's another use case. In the US, there's a famous football team called the Green Bay Packers. The Green Bay Packers, shockingly, is owned by the people that live in Green Bay, Wisconsin. Now, if you own a team, you have lots of fans, and you always want more fan engagement. Maybe you could sell 1 or 2% of your team using our system to fans. That's another use case. You can have a use case with selling AI. Wow, you mentioned AI to start. Think about this huge amount of capital that's going in to build data centers. Well, all different flavors of data centers. You could use our system to auction off capacity to potential buyers of that capacity. So there are almost endless use cases for what we've created. Now, you'd say, being the steely-eyed guy that you are, all right, Alan, where are you going to go with this company? When I built the insurance exchange, early on, we had some people that wanted to buy it, some big companies, some big European insurance companies. My investors at the time said, oh, no. Even though the prices were very attractive, they said, oh, no, it'll be worth $1 billion. Well, great. So we passed. And it took 10 years to build it out until Allstate landed. Here, I would say, if I were back when I was a young lad in the securities business, I would say a large securities firm has huge amounts of use cases for what we've built. They have an army of people out selling what they're building. Imagine if Morgan Stanley had what we have. They could use it all over the place. So maybe we'll find, and we have some interest, of people saying, Snyder, get the hell out of the way. We're big, you're not. We can leverage the intellectual capital that you put into this faster than you can. So we'll see if that's a possibility. Second, we have had interest from some big music companies that have said, you know, we could use this, but if we use it, we don't want any other music company to be able to use it. What would you sell us, Alan, or charge us to get an exclusive license on your tech stack for 3 to 5 years? That's another possibility. Third, and this is the third one that's kind of fun. We could use another infusion of equity of $10 million. So maybe we'll have somebody that says, Alan, here, we'd like to invest. You've already spent $7 million to build it, and it works. It's not vaporware. We can reach out, touch it, and prove that it's everything you say it is. But let's give you the money to build it as it sits. So those are the three possibilities that we're exploring today. And I think we'll keep an open mind to any of those three. Let me pause and see what questions you have for this rascal.
I really appreciate your insight and the description. This is like amazing for me. I used to be on the market 20 years ago. It was a one-man show. I used to trade commodities and derivatives. I used to be an option seller, and I was trading options on different market, on the S&P or bonds or even commodities. Then coming
Then you
back
went
to the
straight.
market today makes me give me goosebumps. And you blew up 20 of my questions. That's why I let you talk. I don't need to interfere. I mean, it was perfect. Of course, if I had to come back, and the hardest part of building aShareX so far, is it or was it educating the market, navigating regulation, or maybe creating liquidity? I mean, at the beginning, but what is it, or all of the above?
Well, that's an experienced man's question. Building the trading system, given that you and I both share an options heritage, I got into the Wall Street just as the CBOE was starting and built a big options business. Building that system was difficult because we had to figure out all of the edge cases that could happen in any trading system. So that was quite a challenge. It took us quite a bit of time, unfortunately, and money. Second, I felt it was really terribly important because I'd seen a number of players come a cropper by cutting corners on the regulatory side. Let me digress for a second there in a fun digression, I hope. Early on, when I had this idea, I said, oh boy, let's use blockchain and tokens. Ooh, hot, but there were problems. The SEC does not recognize the immutable record keeping of the blockchain yet, totally. So if you went down the blockchain path, you still have all of the infrastructure to keep the SEC happy. And so what you've done today, it may change. We've architected the system so we could switch almost seamlessly. You just add a lot of costs. I'm an investor first. Don't add costs because it lowers returns. Second, tokens in their early, think of the ERC20 token. In the early days, it was hacked. And still there's a fair amount of hacking. So if you're playing with, large amounts of money, which this platform can handle, you want to be very careful. So we said we'd better let that blockchain execution and tokens mature a little bit further before we add those costs, because they didn't seem to add much value to the investor. So we went down that rabbit hole. The third point you raised, which is a good one, what we're doing is unique, novel, and new. That's bad because people get tied to what they're doing, correct? And it's a new thing. Oh, will it work? Well, we've proven that it works. So we need to get the word out that this is incredibly powerful as a way of attracting this huge new cohort of potential buyers to any asset. Now, if I'm a seller, I've talked about it from the investor side. If I'm a seller of music catalogs, I'm a seller of a venture capital investment, I'm a seller of AI capacity, bringing more buyers to the table warms my black heart. Why? I might get a higher price with more interest in what I'm selling. So that's the word that we need to get out. And maybe with your help and this rambling from me, that'll give us some additional visibility.
Okay. Creating more liquidity.
Yes. Deeper
Very
markets.
interesting. I love it up so far. And okay, then how did you decide what to prioritize between products, education, and compliance?
Well, let me pull the camera back for a minute. If you think about what we're doing, we're creating a marketplace. On the one hand, we need stuff to sell, right? Whether it's a Ferrari, whether it's a music catalog, whatever. Second, and you put your finger right on it, we need bidders. So it's like a giant teeter-totter, a seesaw. You go back and forth, more stuff to sell, more bidders. And that really means creating visibility for what we're doing and or partnering with people that either have the products and or think of the sports teams that have fans. Think about music. If you're going to sell a catalog of Beyonce, oh my Lord, does she have a lot of fans? Now, those fans, you would think, and we've actually researched this a bit, would love to have a piece of her song, but they can't today. So, again, you could label what we're doing is really democratizing, making it available to a wider audience that today is screwed. They can't play. So it's both. Unfortunately, it's both.
Okay. Yeah, I mean, that makes sense. That's for sure. But do you see investors' behavior changing towards wanting more control and or more liquidity?
Well, both control and liquidity. If you think about what we're doing versus the traditional structures, we're giving people more liquidity and more control at the same time versus the typical Reg D structure that is generally used for alternative assets. And it's an overworked word, overused word. We're empowering investors with greater liquidity and greater control. So that's the whole thesis, if you will, of aShareX. And I get excited about it. I
No,
apologize.
of course. Yeah, I mean, no, I love it because your excitement make me feel great, and I hope our audience will do the same, and I'm sure. Um, okay, then let's move to tech or AI, and given the range of asset classes you are handling, how do you keep valuation data and investor confidence accurate? Are you using AI for your KYC, onboarding, or even appraisals?
We use AI on appraisals for sure. But again, you think about it, we're basically giving people lots of information. If you look at the Ferrari thing on our website, we used AI and said, okay, here are a number of different AI chatbots. Here's what they say about this particular Ferrari and what it might be worth. And so we've used that. We're just beginning to use AI agents to reach more bidders by learning and targeting more crisply the message to an individual and saying, hey, this might be up your alley because this is what you like. There's this new phenomenon of AI agents to help you do that. So yes, as to valuation, yes, as to some of the marketing tools. And as we scale, clearly you can use having in the insurance business, having had two large call centers, there's a lot of utility with AI and call centers. And as we scale, I can see that being a good use case for AI for this company. Now, again, just to bore the audience, if anybody's interested, this white paper, send me an email and I'll be happy to share it with you. It's lengthy, but it goes down to the blades of grass on fractionalization, what the alternatives are, what the regulations are, et cetera, et cetera. It's for people that are interested in the space.
Yeah, and I got it and I love it. I put it into a Notebook LM and they squeezed the thing. It's worth reading. It's worth reading.
Well, you're very gracious. Thank you.
Then, okay, then know your customer for sure. It's important. Is there a future where AI will match investor automatically with asset opportunities?
Maybe. But I have to say, and this will date myself, you think about this AI almost mania that's out there, right? You and I lived through, I did personally, the web boom. And at one point with the web, it was just everywhere. It was going to take over the world. And for 3 or 4 years, anything could get funded. But then the music stopped in the early 2000s because too much money had flown into the space. The claims were hyperbolic. And I worry with AI that you might maybe, I'm a prisoner of the past of the web. I wonder with AI if some of the claims may not have gotten ahead of the reality. Creating individual AI agents that are tailored to the specific data of a company is hard work and lots of challenges to execute that. So I wonder if there's maybe a little bit too much capital flowing into the space. Great opportunity, certainly incredible changes ahead of us, but it may take a little bit longer than I think everybody believes. Yes, adoption. You put your hands around the issue. It's getting adoption and comfort from people to use it, to leverage it. It was sort of like with the insurance exchange, same problem. We were very early. And whether it was insurance companies saying to us, oh my God, Alan, you're going to give price visibility to the consumer. Yes. Giving them knowledge to compare and contrast. Yes. But it scared the hell out of a lot of people. So used to have to tie a pork chop around my neck to get the dogs to play with us. It was hard. I think that's the big challenge for us. And that means we have to do more. We have to do more auctions. We have to get more different product categories that we're bringing to the public. That's our challenge. Yes. Yes. Partnering with people that have the items, the goods, if you will, and maybe the potential investors. A good, simple example is any music company. The artist has fans, the music company, and they may want to sell a catalog of songs. So they have a couple of neat things. They have the asset generating royalties. That's attractive. And they have a fan club that would love to own a piece of that artist indirectly. So there you have a very simple, clear, crisp use case. Now we got to get somebody to say, okay, Snyder, aShareX can help us execute better. That's I think the cleanest example. Wall Street firms is another natural for this tech stack. And go ahead. Sorry. Well, I think back when I was in a big securities firm, building stuff inside a big company is really, really hard. That's why drug companies these days frequently say, the hell with that. We will buy a small drug company that has gone through the pioneering and the testing of their drug, the intellectual capital behind that, and we'll buy it because they can execute it more efficiently than we can. So we'll buy those little companies and then leverage our platform. I think it's that concept. Well, they can buy us or they can try to build it. Now, you say, all right, I'm going to replicate, duplicate what aShareX is. Okay, you better bring a lot of intellectual capital to the table. You better figure out a way to circumnavigate the patents pending we have, which are, holy smokes, 250 pages of light reading. So you have to bring the energy, the intellectual capital, and the hurdle, the speed bumps of these patents. Is it easier just to say, well, let me rent it, let me buy it? It gives me speed to market. That's what I would say. Yes, absolutely. And it sounds terribly corny and maybe hopefully not childlike on my part. I think it's pretty nifty to be able to give a wider audience the same advantages that the uber wealthy have. Why did the uber wealthy buy a Picasso? Why? Because it holds value better than some ultra contemporary artist, which is speculative. And yet those Picassos are out of reach of almost every investor. So kind of fun to empower investors with what we're doing and giving them the same opportunity to buy high quality assets that the uber wealthy, the institutional investor have had. And by the way, you'll laugh at this, as you should, at me. I was talking to a friend of mine a little while ago that runs a large endowment fund. He said, Alan, what are you up to? And I was rambling and talking about aShareX. And I said, well, it's really for individuals, blah, blah, blah. And he said, Alan, I run a large endowment. What you're doing has appealed to us. I said, why? He said, we invest in stock. We love alternative assets, but we like the regulatory oversight of the SEC. You give us that. You give us true price discovery. And as an institutional investor, we love the ability to control the asset, not delegating all of that to a money manager. So as you get rolling, Alan, think about institutional investors like us, where you're giving us something to encourage us to play in these alternative assets, to invest in them. And it was an epiphany for me. I hadn't thought of it. I think it's fun to be able to help people. Sounds sophomoric, maybe, but I think back in the Discover card, it created a wider audience. I think the insurance exchange was, people are screwed. They can't evaluate which auto policy, which homeowner's policy is best for them. And the other motivation, when I came out to California years ago and I got my head handed to me, I came out to restructure California's largest insurance company. $20 billion of assets, $18 billion in high yield bonds, as Drexel was going under. Jeez. And it was imperiled. The thing that kept me going was, apropos your question, I had one mission. I'd never had it so starkly rendered. It was to every day say to myself, did I improve the position of the policyholders that were terrified that they were going to lose all their money? Had I moved the needle just a smidgen every day? That kept me going. So it's that kind of stuff. So clearly I'm that jerk that you're talking to that tilts at windmills. Well, I think there's two ways. One is aShareX, aShareX.com. What the hell? You may even want to bid on a piece of that upcoming Ferrari coming up soon. That's one. Then, if you're a hardcore investor like you might find some of this stuff. I write articles that are on Shinnecock. It's an Indian name, SHINNECOCK.com. There's a whole bunch of articles about investing on Shinnecock.com. Thank you.